Morning, welcome to a tasteless session for accounting at Severian College. I'm really sorry that you can't be here live with us in front of us and really get a feel for the college, but hopefully this is the next best thing and will give you an idea of the subject and that you want to take it when you decide what A-levels you're actually going to do. So I've got a PowerPoint I'm going to run through and hope you enjoy. Okay, so welcome to accounting at Severian College. So the objectives for today's session are to learn about the content of the accounting A-level here at Severian, be able to identify the difference between an asset, liability and capital, and to help you understand and apply the basic principles of double entry bookkeeping. Now, because it's a live event, it's very difficult to give you an exercise to do. So just bear in mind that if you were in front of us, you'd be drawing the accounts and practically getting involved in the calculations and where things go. But it's just an informative alternative, I'm afraid, but hopefully give you a good taste of what the course would be like. So you might wonder why I put 4 pictures of businesses up there. So these are accounting firms. They are known as the Big Four, and they are the Big Four accounting organisations within the UK. What do you think the average salary for working in one of these organisations would be? Well, I had a friend who worked at KPMG, and early days in her career, she was earning about £50,000. She's moved on now, but while she was earning £50,000, I think one year she got a bonus of £30,000 just at Christmas. So can you imagine that? Just before Christmas, a nice £30,000 bonus on top of your already quite decent wage. So if you want to be an accountant, you aim high, you aim to be one of these, work at one of these top organisations. That said, there are equally good large firms that will pay you not quite as handsomely, but you will still be able to make a lot of money. What an accountant does as well, once you've passed your professional exams, what being an accountant can do for you is many accountants, they move on, and they don't stick with ordinary accounts of a company. They move on to other jobs in society. What having those professional exams does for you is it opens up the top jobs in society. You'll often find the chief executive of an NHS trust, or the chief exec of a local council, or top CEO of one of the top companies in the UK. Often, not always, but often they will have a financial background, and that means having those professional exams really allows you to enter the top jobs in society. Why choose accounting? Well, it's a qualification that will always be helpful. Whether you decide to run your own business, you will need some kind of financial knowledge, or whether you work for an organisation, even a charity or anything, having knowledge of how the finances run and how using that data can help you make good decisions will always be of benefit to you. Whatever you do, you will work for some kind of organisation. The course will help you understand the responsibilities of the accountant and the impacts of their recommendations on the wider environment. It's a 2-year linear course. It's all exams, no coursework, 2 3-hour exams to be sat at the end of the 2 years. So we have regular testing, but your formal qualification will be at the end of the 2 years in the form of 2 exams. It's an enjoyable course, but challenging. It requires a lot of hard work and commitment. I love accounting as a subject. I studied it at university, and I love solving problems and looking at all the data, and it's my job or your job to organise the data, to organise the numbers that you've been given and find the story that they're telling. Every set of numbers, what a business has spent, how much it's spending on expenses, what it's selling for. They all fit together to tell a story, and it's your job to interpret what that means and make suggestions and improvements to make that business better and more profitable. Accounting is successful at Severian. We have high pass rates and high grades in line with the national average. And we find a lot of students go on to study accounting after they've finished their A-level here at Severian, whether that's an apprenticeship with one of the top companies or an apprenticeship with not one of the top companies, or whether it's to university. Often, I think it's about 80% of our students stick with accounting. It really is a subject, if you like it, it can get you, can grab you, and you stay hooked on it really. Now, I'm not going to read through all these different 18 topics, don't worry, but this is a summary of the subject content. You'll find that in if you want to look at the specification in more detail, you should go to the AQA website and search for the accounting A-level, and the specification is there, and it breaks down these topics in a little bit more detail for you. The focus of the course is on two aspects of accounting. The first one is financial accounting. Financial accounting looks at external reporting, so how a business is puts all of their organises their finance and reports it in a set way to show if a business has made a profit or a loss, and it needs to be presented to people outside of the organisation, whether that's HMRC for tax purposes, they're very interested in your accounts, or whether it's for shareholders or investors, or to limited companies have to publish their accounts and make them available for people to see, or for other businesses to see. So that's financial accounting. Management accounting, which we do mainly in the second year, looks at internal reporting. So it looks at costing and ways to improve the business. And you will be, if you're a management accountant, you will report to your internally to your managers. And it's really important that you give them good advice and good information, because they're going to make decisions on the future of the business based on what you tell them. You'll build knowledge and understanding of the key concepts and principles and techniques that you can apply to real life scenarios. And this is what I love about accounting. You develop the ability to solve problems logically, you'll analyse data methodically, and you make reasoned choices and communicate this effectively. It really is that side of it that I love. You know, you get a lot of satisfaction from getting the right answer and working out what a business needs to do to improve. So we'll get to this session. That's a very brief run through of the course itself. If you do have any questions, the Q&A is open, so you can ask the question, and there'll be time at the end for me to run through and give you some information, answer the questions. Sorry. So double entry bookkeeping. Whether a business is large or small, the basic financial principles are the same. So larger businesses tend to present their accounts in a more formal manner because they have to publish their accounts for other organisations or interested parties to use. Smaller businesses aren't fixed by or guided by the same rules. As such, they don't have to present them so formally, but they do have to follow the basic principles. And we're going to start with one of those basic principles today. The first principle that we're going to look at is what we would call the dual effect. The dual effect principle states that every transaction is entered into the accounts twice, having opposing effects, having opposite effects. So what is double entry bookkeeping? It recognises that each business transaction has a dual aspect. It impacts the accounts in two ways. A separate account is used to record the different types of transactions. So if we're going to pay our rent, we would open what we would call a rent account, and we would record all of our rent payments through that account. When we do pay rent, we pay it out of our business bank account. So we would have a record in the form of a T account of our business bank account. So a rent transaction would be entered twice, once into the rent account and once into the bank account. The accounts that we record these transactions are commonly known as T accounts. When you see a T account, you'll understand why we call it that. It's basically just a T with a left side and a right side. We use the term debits and credits. These have been associated with double entry bookkeeping and accounting for more than 500 years. The meaning of the word, so an entry on the left side of an account, a T account, we wouldn't say the left side, we would say the debit side. And an entry on the right side of the account, we would say the credit side. So we don't say left and right, we say debit and credit. The debit and credit rule in double entry bookkeeping can be stated several ways, but for each and every transaction, the total of the debit amounts must equal to the total of the credit amounts. So in short, at any one point, all of the credit transactions should be equal to all of the debit transactions. If they are not, we've made a mistake. So this is what a T account would commonly look like. We have debit and credit on the top. So we would label the debit side, which is the left, and we would label the credit side, which is the right. And in the centre of that T, we would put the name of the account. So if we were paying rent, we would put rent account. If we were looking at the bank, we would say bank account. And how we would record a transaction in that account is we would put the date, we'd put a reference, and then we would put the amount that has been paid or received. Now, when I say reference, what we say is we record the name of the other account that we've used. Now, we're going to run through some examples, so hopefully that will become a bit clearer for you. But that's what a T account would look like, and I'm sure you can see why it's hence named the T account. Since every transaction will involve at least two accounts, always begin by drawing two T accounts. And again, if you're in front of me, you'd be drawing these accounts and you'd be entering the transactions that we're going to look at into your own set of accounts. But for now, just listen and hopefully you'll get the idea of what you would be doing if you were here. So some accounts, like the bank, will have many transactions. If you can think of your own account, how often do you get money paid in? How often do you pay money out? I know for me, I get my wage once a month. And then for the rest of the 28 days, I see all my money going with every transaction that I've made. Well, businesses are a bit more in and out. You know, hopefully they're making lots of sales, so they constantly have money coming in, but they will also constantly have money going out. So if a company were to pay rent of £2,000, they would record the transactions as follows. We have a bank account and we put that the payment for rent on the credit side of the bank account, and in the rent account we put the debit side and we would record. So you can see we've debited and credited, we've kept the balance of debits and credits, and so we've done everything correct. Now there are rules to state which account we would put on the debit side and which account we would put on the credit side. When you're here in September, we'll go through this in a lot more detail. But for now, let's focus on the bank account. And what you need to remember about the bank account is that money paid into the bank account is entered on the debit side. So if it's money received, it's on the debit side of the bank account. If it's money paid, it's entered onto the credit side. So in my bank account, I would have one amount on the debit side every month, and I would probably have hundreds of entries onto the credit side. But for a business, like I said, it's a bit more equal. So what you need to remember today is that money in, we record on the debit side, and money out gets recorded on the credit side. So let's have a go. We've got 6 transactions here. We're going to take each one in turn and we're going to put these into, or we're going to record these transactions into the T accounts. So first of all, you can see we started in business with capital of £5,000 and we paid this into the bank. Now capital is what we call the money the owner has invested. So the owner's investment is what we would call capital. So for this transaction, it's been paid into the bank. So we're going to record that on the debit side, the debit side of the bank account. So you can see there, the 1st of June, from the capital account, we paid into the bank £5,000. Now, at the moment, we've only recorded the debit side. Every debit needs a credit. So we would look to open a capital account and we would record that same £5,000 on the credit side of a capital account. 1st of June, and we've cross-referenced, we've put the word bank as the reference because the transaction, the debit that goes with that credit is in the bank account. Next, on the 4th of June, you'll see that we bought office equipment for £2,500 paid by debit card. So office equipment just refers to anything that we use in the office furniture-wise, desks, tables, chairs. I realise that desks and tables are the same, cupboards. So anything of that nature would be termed office equipment. Now, when we buy office equipment, it's not a cost that we're going to have to regularly spend. We buy equipment to last. So we'd hope that that would last and be of value to the business for many years to come. So office equipment is what we would call an asset. An asset to the business is what the business owns. It's of value and it holds its value and it's of worth to the business. Assets are actually debit accounts. The rules of that we will look at later, but if you look here, we paid by debit card, so it's money going out of our account. So you'll notice that in the bank account, we're going to add to the credit side, 4th of June, office equipment, 2,500. Now that credit needs a debit, so we're going to debit the office equipment account, the asset account, and then the 4th of June, from the bank, we bought office equipment for 2,500. On the 7th of June, we paid rent for the office, £500 by bank transfer. Rent is when we use business premises, but we don't actually own them. So we pay someone for the use of their premises. It's like a form of lending for a fee. So we paid rent for the office, £500. So rent is classed as an expense. Expenses are debited account, there are debit accounts, but really what we're focusing on is that we paid it by bank transfer. So this then is money out of our bank. So it's money paid, 7th of June, rent for £500. We need to debit this credit, so we would go to a rent account, we would open it and we would record in the rent account, 7th of June, £500 from the bank. On the 10th of June, we received commission of £100 into the bank. So because it's being paid into the bank, this is a form of income. I'm not sure if you're aware of the term commission, but you might be more familiar with it in use of sales. So a salesperson often gets paid commission for the number of sales they make. If you make 10 sales, you'll get 10%, or if you make a sale over £1,000, you'll get 5%. So commission is a form of income. So we've received our business £100 into our bank. So we would debit the bank account, the £100, and as you can see, 10th of June, commission £100. Now, as this is income, in the income account, it's credited. Money into the bank, we debited, so this has to be credit for £100 on the 10th of June. Next, you'll see on the 12th of June, we withdrew £250 from the bank for personal use. Now, I'm putting brackets drawings there. When money is taken out of the business for personal use, we record it in a drawings account. So drawings is the amount the owner takes out to use for personal use. So they're taking out of the business and then they can do what they want with that money. But it's recorded in a drawings account. So we're taking money out of our business bank account, so it has to be a credit in the bank, which means we're going to debit the drawings account, 12th of June, from the bank account, we took £250. The final transaction, on the 16th of June, we received a loan of £1,000 from James Henderson by cheque. So it's money received because we've received a loan, but it's also money borrowed. So we want to record that we've received the money, so we record it on the debit side of our bank account. But we also need to record that we owe this money, because I now owe James Henderson £1,000 for the money that he's lent to me. So it's not enough to just say I've got £1,000 in my bank. I have to have a record of what I owe. What I owe in terms of business is called a liability. So assets are what we own and liabilities are what we owe. So I would record in my bank account that James Henderson I've received £1,000 from James Henderson and it's gone into my bank on the 16th of June. Now, if I go to the James Henderson account, the loan account, I record here the amount that I owe. And I've just realised I've made a mistake. You can see there that I haven't recorded the £1,000 that I gave to James Henderson. I've only recorded the £100, which it will be a problem for me when I'm trying to balance my accounts. At the end of putting the accounts together, when we've finished entering every transaction into these T accounts, we draw up what is called a trial balance. And the trial balance is a list of all the debit accounts and all the credit accounts and the balance on those accounts. And if we've done everything correct, the debit side would add up to the credit side. But if I added up all the debit transactions in my example here, and then all the credit transactions, I would find that I was £900 out. So the trial balance is a way for me to find errors and then correct them. I would find this mistake and I would enter the correct amount of £1,000. Okay, so you might say, why bother? It seems quite a long, tedious process. If you think we've only looked at 6 transactions and we had to record it 12 times, can you imagine the process for recording for a business that makes many transactions daily, not even monthly? But there are consequences to not following the rules. Businesses, and more specifically financial accountants, can get into a lot of trouble if they are caught acting fraudulently and not following the rules. There are international accounting standards that must be followed on, as you can guess, an international basis, and that means that companies work multinationally but internationally, so there can't be so many differences from country to country. So there are international accounting standards that must be followed. A country's tax authority will enforce that these standards are met, because if people aren't governed, or businesses I should say, if businesses aren't governed, then you will find that some businesses will misrepresent what they're earning to benefit them, like paying less tax or making themselves look better so they get more investment. So it's really important that these rules are followed. There can be internal consequences for business if they don't report their finances correctly. Decisions can be made. You could invest in machinery when you don't actually have the money that you thought you did, or you can not charge enough for products and not cover your costs. So, and that all of those problems would eventually lead to bankruptcy. But there can be serious external consequences if it's not followed as well. So the question, why bother? Well, it's the law to bother, but actually it's there can be serious consequences if a business doesn't bother to follow these rules. So I've got some examples here of what happens when things do go wrong. So there was a 1.7 billion fraud at Olympus that was unearthed in late 2011. The previous management had buried losses for 13 years, so they'd manipulated their accounts to cover that the business was actually making a loss. This is illegal and fraudulent on many fronts. The company's former chairman and 2 other executives received suspended sentences, and an advisor to the company was sent to jail for 4 years. Now, the advisor would have been the accountant. Having that added level of education, passing those professional exams, means that you hold a position of trust and responsibility in society, and just having those exams gives you that added trustworthiness. And if you break that trust, there's very serious consequences for you. So it was the advisor, the accountant for the company, that took most of the blame. Tesco, a number of years ago now, revealed it had overstated estimated profits by £263 million. They overestimated revenues paid to by their suppliers. It was serious fraud. The Serious Fraud Office investigated Tesco, and they cleared out their board and their UK management team. It was a big scandal at the time, which I think they've recovered from now, but that's because they cleared out all of their senior management. One of the biggest and famous accounting scandals was in 2001 with a company called Enron. There's a documentary, I think you can find it on YouTube, it's actually really interesting, and it tells you all how they got away with it, what they did, and you know, this scandal in particular has resulted in multiple people being sent to prison. I'm sure you all know who this guy is. So this is the most recent scandal, I would say. The former US president, his company and its finance chief were charged with tax-related crimes. Alan Weisselberg has been charged with concealing 1.7 million worth of income. Now you'll notice here that no charges were brought against Mr. Trump. Even though he'd signed some of the checks off personally. This is because it's the accountant that is the one that is to blame or thought to blame. Regardless of the pressure that they're put under by the owners of the business, it's them that have broken the international accounting standards, and they're the ones that hold the position of trust that they've broken. In these extreme cases, you will go to jail if you're found to break the law. So when I ask you a simple question, why bother? It's important to bother, and it's your job as a prospective accountant to know the rules, follow the rules, and give good advice to companies where they can make the most money, but do it in a legal way. Okay, well, thank you for listening. I hope you found it enjoyable. I think I'm going to ask any questions. There have been some questions. I've got some here. So I'm going to answer these questions. And yeah, here we go. So I've been asked, what's the maths like? So the maths is probably a misconception that it's a maths equivalent. You won't study the like trigonometry and all of that you would in maths. It's a subject in its own right that uses maths. The skills that you would use are you would use basic math skills like addition, subtraction, percentage changes, increases, you do ratios, but really it's the analysing skills, the problem solving skills, the logical sequencing. It's those kind of math skills that you would use really. So if you're competent with numbers, you like problem solving, and you're reasonably good at maths, you don't need to be a maths genius. It's the competency of numbers that will help you. Do you have to have done accounting before to study? No, definitely not. It's one of the few subjects that most people, I think I've had 2 in the whole time I've taught here who've done it at level 2 before. It really isn't a subject that people generally have done before. So you will not be on your own in the classroom not knowing what to do. We start at the very beginning and work our way up because everybody has the same starting point. Just been asked about trips. I think as a faculty, historically we've offered London trips, we've offered New York trips, we do day trips, so we do offer trips. The pandemic has kind of put a hold on that, so for the last 2 years we haven't been able to offer anything, but certainly as we're coming out of this and hopefully in your time at Severian, we'd definitely be able to offer those trips again to you. So do you have to go to uni to be an accountant? No, definitely not. There are 2 routes to become an accountant. You finish your A-levels here at Severian and you go to university 3 years, then you join an accounting firm and you do your professional exams, and that's another 3 years. So all in all, it's a total of 6 years. Or after finishing your A-levels at Severian, you can do an apprenticeship at an organisation, and they will support you through 6 years of study to get your professional exams. Both routes take 6 years, so there's no time-saving element to either route, but there are advantages and disadvantages to both routes as well. But no, you do not have to go to university. Entry requirements for the course: you need a minimum of 6 GCSEs, grade 5 or above, but 2 of those at least need to be a 6 or above. The exam is a mixture of multiple choice, practical questions and written. So it's about 50% practical, 50% written. And A-levels that go with accounting, we tend to get a lot of students that do business, economics, law, some sciences, maths, but really it could go with anything. If you're an artist and you want to run your own art gallery when you're older, knowing the finances is going to help you. So I would argue it goes with anything. But yeah, that's up to you. Choose subjects that you're interested in. You'll tend to do a lot better if that's the case. Okay, I've got no more questions, so if that's everything from me. I think you can still ask questions after the event, which I can answer if I've not mentioned anything that you're interested in. But other than that, thank you for joining me this morning, and I hope you have a good next session with whoever you're choosing. Thank you.